Think about a company's long-lived assets, which might include items ranging from buildings, equipment, computers, furniture, patents, copyrights, and other intangible assets. How are these assets utilized in the production of revenue? Do you believe that the historical cost of these assets should remain on the company's balance sheet until they are disposed of? This week, you will learn the answers to these questions and more. You will also learn about how to account for cost allocation, both in terms of depreciation and amortization pertaining to tangible and intangible assets, respectively. You'll also learn intangible assets with indefinite lives, such as goodwill, are not subject to amortization. But nevertheless, these intangible assets are subject to impairment, as well as other operational assets. This week, we will journey with these long-lived assets through their utilization and operations, all the way through their disposal. Property, plant, and equipment, or PP&E, and intangible assets are purchased with the expectation that they will provide future benefits, typically for many years into the future. These assets are required to generate revenue for the company. Therefore, the cost of these assets should be allocated to the period in which their benefit is derived. According to U.S. GAAP, the chosen method of cost allocation should allocate the cost as equitably as possible to the periods in which the benefits are obtained from its use. Methods should produce a cost allocation in both a systematic and rational manner. Before we jump into the methods for cost allocation, it is important that we share some terminology. The first is salvage, or residual, value. This is the estimated value that a company will receive when it sells the asset. For intangible assets, this is likely to be zero. The residual value is not zero if, at the end of the asset's life, the asset will benefit another entity and can be sold. Next, we move on to the book value or carrying value. This is derived as historical cost less accumulated depreciation or accumulated amortization in the case of intangible assets. Next up is accumulated depreciation. This is a contra-asset account, which means it has the opposite balance of a natural asset, meaning that it naturally occurs as a credit balance and is always coupled with a respective property, plant, and equipment account. Next up is the allocation base. Sometimes we also refer to this as a depreciation base. This is equal to the original cost, also known as the historical cost, minus the expected salvage or residual value. As we continue with our shared terminology, we discuss the estimated service life or useful life. This represents the amount of time an asset's expected to be utilized in operations, which can differ from its physical life or legal life in the case of intangible assets. An asset's physical life in the case of property, plant, and equipment is limited by physical factors such as wear and tear. These factors can set the outer limit for an asset's useful life to an organization, whereas an asset service life for both tangible and intangible assets is only limited by economic factors such as inadequacy, supersession, and obsolescence. Depreciation is the process of cost allocation where the cost of tangible assets is an expense in a systematic and rational manner to the periods expected to benefit from the use of the asset. This is a matching of cost with revenues under the expense recognition principle. Depletion will not be highlighted in our review as it relates to the cost method allocation used for natural resources which are physically consumed over a period of use, such as petroleum, minerals, and timber. Amortization represents the cost allocation method to record the expiration of intangible assets such as patents, copyrights, and trademarks. And finally, impairment is when the book value of an asset is not recoverable and a write-off must be recorded. As we move into the exploration of allocation methods, we begin with a straight line method. This is by far the most easily understood and widely used technique for calculating depreciation. In this approach, an equal amount of depreciation base or allocation base is allocated to each year of the service life. The depreciable base is simply divided by the number of years of the asset's life to determine its annual depreciation. It assumes that the economic usefulness of the asset is the same each year and that repair and maintenance expenses are essentially the same. So, why do so many companies use a straight line method as opposed to other time-based methods? Many companies consider the benefits derived from the majority of depreciable assets to be realized approximately evenly over the asset's useful life. Certainly, a contributing factor to the straight line method is that it's the easiest method to utilize and apply. Another motivation is the positive effect it has on reported net income. Straight line depreciation produces a higher net income than accelerated methods. In the earliest years of the asset's life, The straight-line method is calculated by taking the historical cost less the salvage value and dividing it by the estimated service life. The estimated service life is most often given in years. That said, it can be derived in months, and therefore, whatever basis the denominator is or the bottom number in your equation will fuel the output. So therefore, if the bottom number is in years, then the output will be a per-year amount. If the bottom number or the denominator is in months, then the output, in fact, will be on a per-month amount. The next method we explore is the activity method. This is fundamentally the straight-line method. However, you'll notice that the denominator is a different per-unit basis. Perhaps the most logical way to allocate an asset's cost to the period of an asset's use is to measure the asset's usefulness in terms of its productivity, either in terms of hours or units. The most common activity-based method is, in fact, called units of production. The measure of the output used is an estimated number of units, either in pounds, items, or barrels, to be produced by the machine. In the units of production method, we first compute the average depreciation amount per unit by dividing the depreciation base or the allocation base by the number of total units expected to be produced over the asset's lifetime. This per unit or per hour rate is then multiplied by the actual number of units or hours produced during the period. You can see the calculation as provided. Historical cost less residual or salvage value divided by the estimated units of productivity. Or this could also be estimated units of productivity in terms of hours. Again, the denominator fuels the output. So it's going to be a per unit amount or a per hour amount, in which case then you need to call up the plant controller, find out how many hours or how many units the machine was utilized, and multiply that to get your annual depreciation expense. Using either the straight-line method or the activity-based method implicitly assumes that the benefits derived from the use of the asset are the same each year in the case of straight line or the same amount per unit. In some situations, it might be more appropriate to assume that the asset will provide greater benefits in the earlier years of life as opposed to later. In these cases, more appropriate matching of depreciation with revenues is achieved with a declining pattern of depreciation, with higher depreciation in earlier years and lower depreciation in later years. An accelerated depreciation method also would be appropriate when the benefits derived from the asset approximately are equal over the asset's life, but perhaps repair and maintenance costs significantly increase in later years. The earlier years will incur higher depreciation and lower repairs expense, while the later years will have lower depreciation and perhaps higher repairs and maintenance. Two ways to achieve such a declining pattern are the sum of the year's digits and the declining balance method. Conflicting with the desire to report higher profits under the straight-line method is a desire to reduce income taxes by reducing reportable taxable income. An accelerated method serves this objective by reducing taxable income in earlier years of an asset's life in comparison with the straight-line method. Income tax regulations allow a firm to use different approaches to compute depreciation in their tax returns than in their financial statements. This method for use for tax purposes, therefore, is not a constraint in the choice of depreciation methods as it was in inventory. As a result, most companies use straight line for financial reporting purposes and accelerated method for accounting for income tax. As we explore the sum of the year's digits, this requires the multiplication of an asset's depreciable cost by a fraction that decreases each year in the asset's service. We begin with the allocation base multiplied by the number of years remaining at the beginning of the year. So if we had a 9-year useful life, we'd start with 9 and we'd work our way backward. So 9, 8, 7, 6, 5, 4, 3, 2, 1. And the sum of the year's digits is, in fact, almost a common sense calculation, if you will. If we were dealing with 9 years, we would take 1 plus 2 plus 3 plus 4, all the way up to 9 for the denominator. Or let's imagine we had something that had a 48-year life. We might need a calculation to calculate that, or it would take a long time on the calculator. So the calculation is that n equals a useful life. So 48 multiplied by 48 plus 1, or 48 multiplied by 49 divided by 2. Our final allocation method is our last accelerated method, called the declining balance. This method multiplies the beginning of your book value, not the depreciable base, by an annual rate that is a multiplier of a straight line rate. Salvage value was therefore ignored in this periodic calculation. However, the asset cannot be depreciated below the salvage value, which means you need to manually stop depreciating when we get to that point. The most common method of declining balance is known as the double declining balance method. Under this method, we multiply the asset's beginning of the year book value by double or 200% of the straight line rate. The straight line rate is calculated by taking 100% divided by the useful life. So, for illustration purposes and simplicity, let's imagine that the useful life is 2 years. So 100% divided by 2 is 50%. Multiplying it by 2 would be 100%. So 100% would be the consistent rate that we would use on an annual basis. There are 2 special issues that we should consider. The first is partial depreciation methods and a revision to the estimate or method when the acquisition or disposal of property, plant, and equipment occurs. At times other than the very beginning or very end of a company's fiscal year, we must determine how much depreciation to record for the part of the year in which the asset has been actually used. Some companies adopt a simplifying assumption or convention for computing partial periods of depreciation and just use that consistently. A common convention is to record 1/2 of the year as full depreciation in the year of acquisition and another half in the year of disposal, regardless of when the asset is placed in service. This is known as a half-year convention. As we move on to changes in estimate or method, changes in the estimate are accounted for prospectively. When a company revises a previous estimate based on new information, prior financial statements are not restated. Instead, the company merely incorporates the new estimate into any related accounting determinations from then on. It usually has some effect on both the balance sheet and the income statement for current and future periods. A footnote should describe the effect of the change in estimate on net income and the related earnings per share of the amounts in the current period. When we think about changes in methods, these changes are also accounted for prospectively, exactly in the same way that we account for a change in estimate. One difference is that changes in estimates do not require that companies justify the change. However, if a change in estimate is a result of the company changing an accounting principle, then a clear justification as to why the company switched would be required. Finally, we move on to some end-of-life conversations for property, plant, and equipment. After using property, plant, and equipment, companies will either sell or retire those assets. When selling property, plant, and equipment for monetary consideration, either cash or receivables, the seller may recognize a gain or loss for the difference between the consideration received and the book value or carrying value of the assets sold in a sale. The proceeds from the sale less the book value. If this number is positive, it will be determined as a gain. If it's negative, it will be a loss. Keep in mind that our book value is calculated as historical cost less accumulated depreciation. We might also encounter the concept of involuntary conversion. In this case, the proceeds will be perhaps non-negotiable. We'll compare that to the book value, which really puts us in no different place than in the sale. The calculation of gain and loss is the same, as well as in any other type of disposition, regardless of whether any resulting cash proceeds are going to be reinvested in the replacement asset. And finally, we consider abandonment or donation. In an abandonment or donation, the proceeds will be deemed zero, which we will compare to the book value, most likely resulting in a loss. Sometimes management plans to sell property, plant, equipment, or an intangible asset, but that sale hasn't occurred yet. In this case, the asset is classified as held for sale and the period in which all the following criteria are met. First, management can commit to a plan to sell the asset, and the asset is available for immediate sale in its present condition. Second, an action plan to locate a buyer and sell the asset has been initiated. Third, the completed sale. The asset is probable and expected to occur within 1 year. Next, the asset is being offered for sale at a reasonable price relative to its current value. And finally, management's actions indicate that the plan is unlikely to significantly change or be withdrawn. An asset that is classified as held for sale is no longer depreciated or amortized. An asset classified as held for sale is reported at the lower of its current book value or fair value less than a cost to sell. If the fair value less cost to sell is below book value, we recognize a loss in the current period. If the financial statements are again prepared prior to the sale, we reassess the asset's fair value less the selling cost. If further decline has occurred, we recognize yet another loss. If the fair value less the selling cost has increased, we recognize a gain, but only limited to the cumulative losses previously recorded. Next, we move on to indefinite life intangible assets. Intangible assets with indefinite useful lives are those with no foreseeable limit on the period in which the asset is expected to contribute to the future cash flows of the entity. Because of their indefinite lives, these intangible assets are not subject to periodic amortization, but keep in mind that indefinite does not necessarily mean permanent. For example, while the life of a trademark or trade name is initially considered to be indefinite based on 10-year infinite renewable periods, the cost of the trademark would not be amortized. However, a company after several years could always decide to phase out of that production, and therefore an impairment test would be needed. Examples of indefinite life intangible assets include trademarks and trade names that are used in the example, as well as the most common, which is goodwill. Asset impairment is calculated as a two-step process. The first step is the recoverability, or what I call the smell test. This does not, in fact, calculate the impairment. Impairment occurs if the sum of the expected future net cash flows undiscounted is less than the asset's book value. So here in this example, we have an asset that has a current book value of $8 million, and the expected future net cash flows, which will be derived by a complex calculation given by our finance professionals, is $7 million. Therefore, the expected future cash flows of $7 million are less than the book value. Therefore, we would move on to step 2 and the impairment test would be needed. If, in fact, the expected future cash flows were $10 million, then step 2 would not be required. We'd simply write up a memo for our files that the recoverability test was passed, and we move on to the next annual reporting period. Step 2, however, is the impairment test. If the impairment has occurred, we recognize an impairment loss for the amount by which the book value of the asset exceeds the fair value of the asset. This is assuming that the active market exists for an asset. If there is no active market, then we use the present value of the expected future cash flows. So in our calculation, we have that $8 million book value. And let's assume that we were given the fair market value of the asset to be $4.4 million, and therefore the impairment loss would be $3.6 million. If the impaired asset is still held for use in the operations of the organization, the book value of the asset would be reduced by the impairment loss. This would be done by simply increasing the accumulated depreciation. In this example, for equipment, we'd record the loss and impairment of $3.6 million. The book value is not written up, even if the fair value of the asset increases in future years. Depreciation is taken on the new book value over the asset's remaining life. If instead the impaired asset is intended to be sold, then it would be reported at the lower cost or fair value, less the cost to sell, i.e., net realizable value, and there is no depreciation expense for the impaired asset being held for disposal or sale because the loss would be recovered at the time of sale. This slide provides an excellent summary of the asset impairment guidelines for property, plant, equipment, indefinite life intangible assets, as well as goodwill, as well as assets held for sale. In our final topic, we move on to costs subsequent to acquisition, including additions, increases or extensions of existing assets, improvements and replacements, substitution for improved assets of an existing one, rearrangement or reinstallation, which is the movement of an asset from one location to another, and finally, repairs, expenditures that maintain an asset's condition for operation. This slide provides an excellent summary of expenditures subsequent to acquisition. Repairs and maintenance are expensed in the period in which they occurred. Additions are capitalized and depreciated over the remaining useful life of the original asset or its remaining useful life, whichever is shorter. Improvements are capitalized and depreciated over the useful life of the improved asset. And finally, rearrangements or reinstallations. If material expenditures are clearly increasing the future benefits, they are capitalized and depreciated over the future periods in which the benefit is derived. Repairs, additions, improvements, and rearrangements generally relate to property, plant, and equipment. One potential significant expenditure after the acquisition of intangible assets is the cost of defending the right that gives the asset its value. If an intangible asset right is successfully defended, the legal costs should be capitalized and amortized over the remaining useful life of the related intangible asset. This is the appropriate treatment of these expenditures, even if the intangible asset was originally developed internally rather than purchased. If the defense of the intangible asset, however, is unsuccessful, then the intangible asset itself has no future value. In this case, the legal costs provide no future benefit and should be expensed immediately. In addition, the book value of the intangible asset should be reduced to its realizable value. For example, if a company was unsuccessful in defending a patent infringement suit, then the patent's value might be eliminated and therefore a loss should be recorded.